All right, all right, all right. There we go. What's going on here? How's everybody doing this morning? Glad you could make it to class. We got a good class here this morning. Nice to see everybody here. So I love it when you guys can make it live. So that's always the best thing. We can always talk live. Now, don't be scared to ask questions. The whole reason you're here is to ask questions. If it wasn't here, if it wasn't for the ability for you to ask questions, I could just do a video and then chop out all the bad parts that I say along the way and all my swear words and all that kind of stuff. I just cut all that out, post a video, and hey, whatever. And then, but you guys can't ask questions to videos. So the whole reason you're here is to be able to ask a question over there in those little question things. So go ahead and ask your questions along the way. And we're going to try and catch up with what we did last night at the university. So last night at the university, we had a nice lesson. We talked about the Black and Scholes model. We talked about some accumulation distribution models. We talked about, we also talked about, what else did we talk about? That's all we talked about. We talked about a bunch of definitions. So we talked about intrinsic value and extrinsic value. We talked about a lot of things. So we're going to go talk about that. And then, of course, most importantly, what we did is we talked about the options chain. So we went down through the options chain. And I'm going to show you how to adjust the options chain because it's quite dynamic. You can do a lot with it. So the markets are kind of, being a little stupid. They're obviously not rallying. They're going down. So almost everything's going down. I wish I had, well, we're going to have to go down through them and look at them. So let's just start with Apple. Apple's on its way down. Let's just work with Apple here at first because everybody loves Apple. So let's just do some trades on Apple just as our example because we all love it, right? We all love Apple. Everybody loves Apple. Okay, so we're going to come in here. First thing we want to do is we just want to do a little technical analysis. Let's look at this thing. Let's come in here and turn on the bulls and bears because that's a really good tool to help us with our technical analysis. So what that does, it comes in here and it shows us from the Wyckoff accumulation distribution model because we always, when we're doing a trade, we want to make sure that we have a reason why we're getting in or out of the market, and that's one of the big deals that I made a big deal about last night. Is that you have to you're always making a decision on whether you think the market's going to go up and down, and even if you say, well, I'm not going to make a decision on whether the market's going to go up and down, I'm going to trade a neutral option strategy. Well, that's making a decision that the market's not going to go up or down. It's going to go neutral. So you're still picking market direction. Every time you put on a position, you're picking market direction. Now, you can pick it based on the fundamentals of the market if you want to, and you can just say, well, this category of strategies are all based for if markets are going up, and you could just randomly pick one, right? I mean, not the brightest idea, but that's how most people trade. They're like, oh, well, I think the market's bullish. I'm going to pick just some random thing because I got this little calculator that tells me I'll make a whole bunch of money if the market's going up. So that's kind of how a lot of people trade. I'm not that guy. I think that we should be a little bit smarter about our decision making. And this is my Wyckoff map. And it's basically how markets move through price and time, and it's driven by primarily the large speculators, well, the large banks and hedge funds and the large speculators. All right, this is how they trade, and they trade by buying low and selling high. And I've talked about this ad nauseum in other videos, so we're not going to go into it in great detail because we got to get to our options. But the point of the matter is markets have a tendency to rise by a certain amount, right, which we call the delta Kona probability or the 3 standard deviations, and then it turns around and it falls by 2 standard deviations, comes back down into the 1 standard deviation from the previous high. So from the previous high and low. So we want to measure that. We want to count that. And that's what a Fibonacci ruler does. A Fibonacci ruler kind of tells us where those numbers are. And so by basing our, just having kind of a roadmap of how markets generally move through price and time, it's going to help us know where to use different option strategies. And when it comes down to it, just remember, we only have 2 options. We have a put and we have a call. That's it. If you think the market's going to go up, you buy a put. If you think the market's going to go down, you buy a call. Now, you can also sell a put and you can sell a call. And this is where people get confused. If you get confused because you can't understand the concept of selling, well, don't sell in the beginning. Just buy and just you're doing it in a demo account, so you'll eventually kind of pick up on the idea, hey, if I sell this, I can do these other things. But you got to understand each individual item, each individual option, or each individual leg of the strategy, so that you can understand what's happening and why you do one versus the other. I don't really want you to just to be doing buys of puts and buys of calls all the time, because not that you can't, you certainly can. And I know people who are very successful just buying calls. That's all they do. Oh, the market's going up, I'm going to buy a call. Doc Brown, for example, that's the only thing he does. He won't do anything else but buy long calls. That's it. If the market's going down, he's out of the market. He doesn't trade. So the only thing he does is he buys long calls, and he's very successful at it. So you can do that, but I think that to add a little bit of nuance to your trading, it's nice if you can figure out how to sell options too to collect the premium. Now, if you don't have an account that allows you to sell options, then don't sell options. You can if you only qualify for an account that lets you buy options, well, just do that. That's okay. There's nothing wrong with just buying calls. You just have to be wise enough to know that the market, you have to be able to find the setups that are going to let you make money when markets make money with a long call. And those are explosive markets. So markets have to pretty much explode when you're buying a long call. So for example, right here would be a good place to buy a long call. Did you know that was going to be a good place to buy a long call? No, but you're going to try it anyway because you got the right signal. Right about here, that's a good place to buy a long call. Right about here, that's a good place to buy a long call. Right here, that's a good place to buy a long call. Is this a good place to buy a long call? Yeah, well, it was. Yeah, took off like a rocket ship. Is this a good place to buy a long call right here? Maybe. I don't know. Is it going to turn around and go back up? I don't know. Our little map says it's probably going to go down again, right? Come in here and look at our map. Well, we kind of went through this little space here. We kind of went down in this one. It's kind of we're going through this little spot right here, probably back down, need it to break below this low, but that's kind of what we're looking at right here, isn't it? It's kind of this little spot right here is kind of this little thing that's happening here. So if everything works out, we should get this thing down here. Let's go and use our Fibonacci ruler and go from the very bottom. Now, generally speaking, we don't go from the bottom of the accumulation stage. And you can see that this was the accumulation stage right through here on Apple. So we generally go after the accumulation stage is already taken off. But it depends on where the big hedge funds mathematical models are coming in, because this is how they do it. And so they come in and they'll lay their delta Kona probability over the market. Now, whether they put it there or whether they go off of this next one up here after the accumulation stage right here off of this low point, some are going to do it here, some are going to do it here. Everybody has different ways of doing it. But you can see right here, if we just discount the accumulation stage, but if we go down to that first explosion, we'll go right there. This is the first explosive run right there. Let's include that in our mathematical model. Well, we've still got some downside potential on Apple to get us down into that one standard deviation. So the one standard deviation, this would be the one standard deviation right here, retracement, between 38.2 and 61.8. That's your halfway or retracement back from that big run up there. And that's usually what markets do. They come back down to the sweet spot of the Fibonacci ruler or the one standard deviation. So this is back into the delta Kona probability. Now, if we go down to the options chain, that whole idea, that whole concept of the Fibonacci ruler and why you measure it and the whole thing, the whole reason you do Fibonacci rulers is because, let's just come in here and do calls, is because of this delta Kona probability right here. It's the delta, it's the convexity of delta. And so delta, you can see at the very center where the market's currently trading is 0.50. So if you take that and you go up the scale, you see that delta gets smaller. And if you go down the scale, delta gets bigger. But if we come in and we do both, let's come in here and do both, the puts and the calls. And, well, actually, we want it to be in the money, out of the money. We want to be out of the money. So, okay, like that. So what we've got, this is not a very good, it's only one day. Let's go out here to 100 days. 120 days on Apple. All right, so now you can better see the delta Kona probability right here in your options table. So this is your options tab, and we talked about this last night, and you can see right dead center is, right now it's 44, but it's like right there is 52. So right dead center of that delta Kona probability is 52. If you go up the scale, delta gets smaller and smaller and smaller. And if you go down the scale, delta gets bigger and bigger and bigger. Actually, this one, it gets smaller and smaller and smaller because we're going puts on the downside, calls on the upside. So that becomes your delta Kona probability as I've drawn it a million times, right? Man, I'm losing my voice. Hold on a second. All right, so let's draw it in there just for fun, just because so you can remember. But that's your delta cone of probability, and that's what it looks like. And the reason we got that, the place it comes from is this options delta right there. It's right there on your screen in the options chain. All right, so that's why we use Fibonacci ruler to measure that delta cone of probability, and that tells us whether the market's at what point in the trend. So right here, as it gets down into this region, this is basically a neutral point in the trend. So the likelihood of it going up or the likelihood of it going down is 50-50. So if you come over here to your probability of being in the money and out of the money, these are the two columns we talked about last night, you have basically a 50-50 chance the market's going up or down. So if you go way out of the money, way up here, you can see that the probability of being in the money is 14%, or, down to the downside, it's way down here, it's 14-15% down here too. So this is the put side. That's why you got the probabilities of being in the money are down here very low. And if you got the call side, well, probability of being in the money up here is very, very low. So that's your delta cone of probability that we talk about so many times. And that's where those numbers come from. The the delta, and if you notice, if you don't have probabilities out of the money and in the money in your platform, the platform you're using, you can use delta, because if you notice, delta is right here is 52. See that? Well, if you come over here to the probability of being in the money, it's 52. The delta is your probability. That's why I call it delta cone of probability. So delta is your probability. If you come up here, probability of being in the money is 33. Delta is 33. Probability of being out of the money is just going to be the opposite of that, 66. See how easy that is? It's not hard. All right, now we're going to come over here, and I'm going to show you. You can right-click on the top of these. And last night we were looking at one of these, and it's premium per unit. That we were looking at, and I was thinking it was premium per day. But you can, if you just right-click on your screen, right-click on the header of your charting program, and usually this is universal across all charting programs, but this is how you do it in Track and Trade. Column setups. And you got all these things that you can put into your delta chain. Now, I don't have all of them put in there because I don't use all of them individually every time I make a trade. So like gamma, vega, rho, I've got delta turned on, but gamma, vega, rho, I don't need those numbers individually. Why? Because those are variables that are in this column right here, which is the theoretical value. That's how the theoretical value, remember, that's our Kelly Blue Book of Options. That's how that theoretical value is calculated by using the Greeks, delta, gamma, vega, and rho. So those are in there. And if you want to see rho, turn it on. You can see rho. You turn it on. There you go. Now you got rho in there. What good's that going to tell you? Not really a lot. We don't really care. So we don't need it because it's already calculated being used over here in the theoretical lot. And that's what's the most important thing. So we can make our table very simple. Or if you're trying to impress your girlfriend, or if you're trying to impress your boyfriend, you can turn on rho, vega, and gamma. Or if you're doing a YouTube video and you want to look like you're really super important, then you can have all these turned on and pretend like you know what they mean, and pretend that you look at them like, oh, no, I'm going to buy me a call. I guess I better go look at rho. Oh, it's 34. I don't know about that. You can pretend like that's important, but it's really not, because those are just variables that are used to create the theoretical value, the Black and Scholes model. So to have them in your column, that's just showing off. You don't need them. All right. So we're going to turn all those off. Now, delta is important. We like delta. Delta tells us how many shares the option is going to be trading at that level. So if you have an option right, let's say you have this option right here, a 270 call, well, it's going to make or lose the same amount of money as 38 shares. And that's your delta. So that's really important. Even if you buy the S&P and hold, you're still picking a direction. Yes, you are. If you're a long hold, buy and hold, you're picking the up direction, right? Absolutely. Even if you're just a long-term investor picking the S&P, you're still picking a direction. All right. So let's come in here and let's go to another thing that's in the columns. See if there's anything else in there that we didn't talk about last night. So we start up here. We got the strike price. That's this first column here. We got the quantity. That's how many we're going to have in there. The premium per lot. That's how much we're paying for each individual option. So in this case, you can see right at the money, $1,552.50. Let me make that bigger. Let me see if I can get down here. There, it makes that a little bit bigger for you. And then, so that's your premium. And then the next column is your theoretical value. That's the estimated fair value of one contract. So that's your Black-Scholes number. And you really need that. If your platform doesn't have it, well, then your platform's not a serious options trading platform. Probably ought to just get rid of it and go get you a platform that has that. Because why would you have rho, vega, gamma, and delta in your options chain, but not have the theoretical value, which is the mathematical model that it uses all those individual variables? Doesn't make sense. Why would you put rho, vega, gamma, and delta into your options chain and then not have the theoretical value? Makes no sense. So if you got a software trading platform and you're going to try and trade options on it and it doesn't have the theoretical value, doesn't have that Kelly Blue Book of options that tell you the Black-Scholes value of the option so that you can find out if it's overvalued or undervalued, go get you another platform. Go get a different one, because they're not serious about trading options if they don't have that. All right. Okay, so that's where that all important column is. So that's right there, theoretical value. So in this case, you can see that the premium right now is $1,562 for Apple. Now that's a put option. See right there, it says put. So a put option is $1,565. The theoretical value is $1,412. Oh my gosh, it's very expensive comparatively. Not very expensive, but it's pretty expensive. 4 or 5, it's like $150 more money than what they're charging. $150 more than what it's worth. So what does that tell you? Why are they doing that? Well, because a put option makes money when the market's falling. Well, look at the market. It's falling. So that's like coming in after the fact and saying, hey, I need insurance today because my house is on fire. So what's the insurance company going to do? Well, they're going to raise the price of your insurance premium way high, because the chances of you having a house on fire when the house is on fire is pretty high. They're not going to give you a discount or a break on it because, it's fair weather and there's nothing looking like no house is on fire today. We'll give you a good price. But when the house is on fire, they ain't going to give you a good price when you're buying insurance. And that's what options are. The whole options world is insurance. So it's akin to the earnest money in the world of in the world of real estate. It's like earnest money, but we think about it as insurance. So we can make money when markets fall. We can make money when markets rise. And if we're in the market long in our S&P 500, for example, then we can put a put option in there. And if the market falls while we're in our S&P 500, well, our S&P 500 shares are going to lose money, but our put option is going to make money. So that would be the insurance policy. It's insuring those positions. You don't want to sell them. You don't want to get out of them because that would be a taxable event. So you don't want to do that. Well, what do? You just sit through it and write it down? No, you don't have to. You buy an insurance policy that says if the market falls, I will stop my losses at the insurance rate that I put in. And so that's what this is. That's how that works. And this just tells you whether the insurance policy you're buying is outrageously high or whether it's low. And then the premium per unit, of course, that's just telling you how much because each option represents 100 shares. Well, then you have 100 shares by the unit price by 100. So if it's 1,565, that premium per unit is 1,565. That's per share. It's almost a worthless number in there. I don't know. You can take that out. Premium per unit. Let's just turn that off. All right. So we can turn that one off. If we hit OK, it's gone. Now we don't have that column because it's just saying that the 100 shares. And that's all it's telling you. Who cares? We know that. All right. So let's get rid of that one. So then we got the theoretical unit. We can come in here and see that. That's this Black-Scholes number telling you by the same thing. Well, it's $1,500. The Black-Scholes number says that it's $14 based on that's a worthless number too. We don't need that. No, we know it's 100 shares. That's all that's telling you, really. So we don't need that. Premium per day. Now that one is kind of a funny one, and I use it. I like it mostly for teaching a device. And the reason is because what it does is it takes up the amount of time that you've got and takes the premium and just divides it by the amount of time and tells you basically on average how much you're losing per day. But we know that theta is not like that. You don't lose time decay at a linear pace. You lose it, it's very slow at first, and then it drops off very fast. So the value of your premium drops off very fast towards the end. This right here, where it's saying premium per day, is at a linear rate. It's just saying on average, you're going to lose on average, in this case, $12.85 per day on average. So if they take the $1,540 divided by the 120, that's all that number is. It's just saying that you're going to lose $12.83 per day, or the market has to go on average up. If you're buying a call, it has to go up $12.85 every day just to cover the cost of the option, just to cover your options premium. So the options premium, meaning, of course, it's your insurance premium, or if you're putting down a earnest money on your purchase. All right, so that's that one. And then we got theta. Again, theta, we don't need it. It's part of the I gotta have theta on my computer. Why? So it's impressive. Makes it look like you got a lot of stuff in your options chain. It's actually being used over here for the theoretical value again. It's going to help you. Theta is just how fast your option is decaying. But looking at it, you say, well, it's 29. Okay, what does that tell you? It's decaying at -20 at minus 29.89. Okay, great. 2 thumbs up. Oh, what's that? It doesn't mean anything. It's a number that's just a variable that's used in other places. So you can turn it off. You turn it on so that you can look cool. All right. Because you don't really look at it and say, well, my theta is at 31. You might be able to get to the point where you're so familiar with the theta numbers that you can say, well, that theta is lower than it usually is, or that theta is higher than it usually is. You could get to that point. I mean, we certainly get there on delta. With delta, we use it so often that we can look at it and say, oh, well, delta of 28 or a delta of 30, that's high or low. Implied volatility, we laugh at that one too. What an implied volatility? It's 30. Oh, my stock is at a delta of a 30. Yeah, but we don't know if that's coming down or if that's going up because it's just one number. Well, you might get to the point where you know that, well, Apple generally trades around a theta of 30. And so you're like, well, it's at 50 today. Well, that's high for Apple. How do you know that? Well, because you're looked at it for 10 years and you kind of have a feeling for how theta is high. But the problem with implied volatility is it's not a 0 to 100 scale. So you can't say, well, anything above 50 is high. No. Implied volatility goes up to 130, 140, 150. It doesn't have a top. So you can't really just say, well, implied volatility is high at 50. A lot of people do. I mean, if it's above 50, it's high. Okay. Go with that. That makes you happy. How's it going to help you? Well, I know implied volatility increases the value of the option. Well, why don't you just go use the tool that was created for that? It's called the Black and Scholes model. It takes implied volatility into consideration. Well, my platform doesn't have implied volatility. So I have to read theta and vega and rho and implied volatility all by myself. Well, stop doing that. Go get a computer, go get a software program that does that math for you, and you don't have to worry about it. It's a lot of people do funny things. All right. I'm just kind of telling you my little pet peeves about being in this industry 40 years and doing this forever, what I've run across. So that's kind of my thinking of it. Doesn't necessarily mean I'm right or wrong. You're going to get other guys, you go talk to them. Oh, you got to have that row on there. If you don't have row on there, you'll never be able to, I don't know how you could survive without it. And they're going to say the same thing, kind of the way I am about the theoretical value. What are you doing? You can't trade an option if you don't know what row is. You got to have it on your screen. Okay, well, maybe they've developed some special, Superman ability to understand how that's going to affect them. So they're better than the Black and Scholes guys because they had to put them all into one formula to come up with this number. They don't look at them individually either. Okay, so there we go. Let's come to the next one. This Lane gets on his pet peeves. All right, I shouldn't have an opinion. I should just be a guy that sits out here and, okay, here's what volume is. Volume is the number of shares traded. Open interest. Open interest is the number of open contracts. I could do that. That would be fun, right? I have no opinion. I don't know why you'd go to a guy that has no opinion. You got to come here because I got an opinion. I'm full of opinions. All right. So let's come into the next one. We got theta. We can turn theta off. Did we turn theta off? We did. Let's get rid of it. We don't need it. All right. It just makes it look like there's lots of things that you have to. It's like going into, you ever sat down in the cockpit of an airplane? And they got, man alive, look at all the stuff you got to learn to be a pilot. It's true. You kind of need to know what all that stuff is. But when you're flying the plane, you kind of look at like 2 things. Well, 6 things. You look at your little 6-pack. And gas. You always got to look at the gas gauge. That's a good one to look at too. But you kind of, you end up, for the most part, you like watching all these gauges. You kind of like watch one thing. Or you look out the window mostly. That's what you do when you fly an airplane. You got all this stuff and you look at like the gas gauge and out the window. That's how you fly an airplane. So this is your cockpit. You got all this stuff, but when you're flying, you kind of look at like 2 things: gas gauge and out the window. So this is the window, and this is the gas gauge. Delta is your gas gauge. The chart is your window. So all the rest of this stuff is just cockpit stuff. It's really cool to have. All right. So the next one here is we got our volume. So we talked about volume. Now, volume, you need that to be high because volume is how many people are trading with you in this arena. If you don't have a lot of people trading, then it's hard to get in and out of the market. You got to have somebody on the other side. So you got volume here. And generally speaking, we like to see volume over 100 when we want to get in because that's going to make a low spread. It's going to make it easy for you to get in and out without having to cost a lot of money. And then open interest is how many people are basically holding on to them overnight. That's kind of what you can think of that number as. But that's how many people are holding it. This is how many people trading it today, in and out, in and out. This is how many contracts traded hands today. This is how many contracts are being held. Open interest. So that's what that is. And generally, open interest, we want that to be 1,000. It's just a rule of thumb. And we all know rules are meant to be broken, right? Just like rules. So if you come in here and say, well, Len, I would really like to have this 880 call. My strategy would really work best if I had that 800, that 270 call at 880, but it's only got 63 volume, but it's got 3,900 on the open interest. Well, come over here and look at the spread. Well, the spread's only $10, and you could probably get half of that if you bid for it. So you could probably get it for $5. Well, that's really good. That's still fine. Yeah, but your rule said it has to be above 100. No, it's a rule. It's like thumbs. They're meant to be broken. So if you come in here and it's $15 and you think you can get it, bid for it and get it for $7.50 or something, and you got 3,900 here and 63 there, go ahead, do it. Just because the rule says that this is 100 doesn't mean you can't kind of fudge the rule. But if open interest is lower than 1,000, then you start to get nervous on that one. All right, that one's a little bit. It's like, if open interest is really big, high, like, oh, look at this, 28,000 of them. 28,000 on this one on open interest. That's a lot, but look, there's only volume of 36. The spread is $10. You're probably going to be fine. You're probably going to be able to get in and out of that market just fine. No problem. Okay. So that's what you're really looking for. That's why volume and open interest are important. And that's why we have the spread listed here and shows you how wide the spread is, because that's a cost of doing business. It's not a commission, but it is. It's basically a commission. You have to pay it. So if you have a commission on top of that, so if your brokerage firm charge you a commission, so you pay the commission and you also pay the spread. That's why you bid for it, because you want to try and get that spread lower. All right. So that tells you right here, this spread percentage just tells you what percentage the spread is of the cost of the premium. So the premium is $565. Your spread is 10. That's a 0.02%. Sometimes that gets up there high. You're like, oh, that's like a 3%. Oh, that's a high spread. I don't want that. I want low spread, low commissions, low cost of doing business. So that's why we look at volume, open interest, spread percent. So there you go. 1, 2, 3, 4 columns. Boom. All for one purpose. Just to find out if the thing's liquid enough to get in and out of. That's what those 4 columns are for. So pretty simple stuff. The next thing is just the last. That's just telling you what they last went for. $8.65. Right now, they're asking, do we have it in here? The last is premium, theta, volume, open interest, bid quantity. See, the bid quantity, the ask quantity, I haven't turned off. Well, who cares? Who cares how many other people are bidding and asking for it right now? I don't care. All I want to know is the volume. How many can I get in? Can I get out? Bid quantity, I guess, if you're looking at the bid quantity, how many people have orders sitting there waiting to be filled, and you could look at it and say, well, I got a low volume, but there's 6 people sitting there that are asking to get in or out of the market. So I could probably get one of those. That's kind of, you could look at that. You could turn that on if you want to. Let's turn it on. So our bid quantity is, okay, we got a volume of 63. That's how many have actually traded hands. But the bid is 120 and the ask is 235. So there's lots of people trying to get in and out of the market. They're just not getting their prices that they're asking for. So their orders are sitting there open, waiting to fill. That's what's happening. So you can see that in there. They're matching them up, and they'll sit here. This one's got ask quantity of 246, bid quantity of 100. So you can kind of see what people are doing right now. You got 100 on the bid. You got 246 on the ask. So if you were going to buy one, they're asking, there's 221 out there asking this much money, or asking to, on the bid and ask to trade. So you can see that the bid and ask, that's kind of valuable. I guess you could see, oh, there's people out there trading this market. You don't have to just look at volume and open interest, but that's really all that's telling you. It's kind of fun to see. We'll turn it on. So we'll come in here. What's the next one? Bid and ask. We got the bid and the ask. We turn on the bid and ask. We turn that on too. We can see the bid and ask. Oh, it's 875 and 890. So you can see that that's your $15 right there. Between 875 and 890, that's $15. You don't have to have it turned on, because when you go to put your order in there, it's going to show up anyway. So you're going to see your bid and ask right over here in the little table. And that's where you're going to bid for it. But you can see it down here too. It's kind of cool. You can turn it on. Hey, it's another one of those things in your pilot cockpit. Do you think you need it right now? If you don't, turn it off. But if you think it's fun to see your bid and your ask, it's still going to come up in the spread as $10. So this here just makes it so you don't have to do the math. You got this column here that just tells you the answer. You can have the math, 875, 885. What's the difference between that? Well, $10. Oh, well, there it is, $10. So there's no reason to have do the calculation and have to do the math if you've already got the answer. If you know what the answer is, if you know what to do with the answer, oftentimes you have the answer, you don't know what to do with it. But that's what the math is. It's just the difference between the bid and the ask, and that's how much the bid and the ask difference is. So that's why I turn them off, because it's like, well, I can see it right there. And then it doesn't confuse people as much. So I can come in here and go bid and ask and just turn that off. Because when I get to the bid and ask, it's over here. I can use it over there. So I don't need that, because I got it right here just in the spread. That's all it's doing. And then the spread percentage. Uh-oh. My screen just went black. I always worry about technical. You know what? Yesterday, I'm going to tell you a little story, a little sideline here, and we'll do the weave, and then we'll weave back. But I was having a lot of problems with my computer, and I'm not done yet, mind you. But I was having a lot of problems with my computer, and after the class, I pulled up AI, and I pulled it up and I put it on my computer, and I said, hey, I'm having a lot of problems with my computer. Every time I do these YouTube classes, it goes really slow. Why? Why does it do that? It didn't used to do that. I said, here, let me go run some diagnostics on your computer. So I said, yeah, go ahead, do some diagnostics on my computer. I went through, spent about 2 or 3 minutes looking at stuff, and it came up with this big report, and it said, you know what? You got all this software that you don't need. Let's uninstall this. Let's uninstall this. And it's this software here. You don't even use that, and it's in memory all the time. It's taking all your memory. So let's uninstall that one, uninstall that one, uninstall that one. You want to uninstall those? Yeah, go uninstall them. It'll save you lots of memory. Do you use them? No, I never use them. Well, then why are they loading up in your memory all the time? Take them out of there. Oh, and by the way, you got this problem here. You got these programs that you don't ever use, and they're taking up all kinds of memory. Why don't you go ahead and remove those? So I removed those. And then it says, now you got like 5 years of historical Pit News magazine articles on your hard drive, and your hard drive's full. Why don't you go move those Pit News magazines from 5 years ago that you've created off onto another drive? And I'm, I'll do that. And I went and did that. And it says, now you got like 5 books that you've written, and you got all the manuscripts and all the stuff on there. It's taken up a huge amount. Why don't you take and move all those books off onto another hard drive somewhere, onto an off-site storage? That'll really make your computer go fast. So I'm like, thank you, AI. So anyway, did you know you could make AI do that? Pretty cool. So it went and told me all that stuff that I should do, and it even told me how to do it, because I'm like, I don't know how to do that. And it says, well, here's where you go. You go into this program and you do this, and it told me all the little steps and told me what to do. It was really cool. The reason I bring that up is because I had somebody, and thank you, those of you who wrote nice things about our university classes to the university. They sent me a note and showed me. They said, look, we got some people said nice things about you. So I appreciate that. Thank you for saying nice things at the university, because that goes a long ways. It takes 10 people, 20 people, takes 25 people to say something good about you for every one that says something bad. One guy says something bad. Oh, it takes 25 people to make up for that one guy that said something bad. So I appreciate it when you guys say nice things. All right. Because I definitely get some guys saying some bad things about me. I'm kind of a, kind of a weird guy. I know that. You'd have to, I'm not for everyone. I'm not for everyone. Okay, so that's what we're doing here. Where did we get to? Oh, the reason I was bringing up the AI stuff is because somebody who said something nice about me said they would like to see an AI class. They said they would like to see Lan Turner teach an AI class, um, so that they could use AI in trading, because I use AI in trading all the time. And I thought, you know what? I've been I'm no expert, all right? I'm no expert in AI, but I'm pretty good at it. Pretty good. I think I'm pretty good at it. I use it for a lot of things. And I've kind of started right at the very beginning. As soon as it came out, I was one of the early adopters. I was like, oh yeah, Chat GPT 1.0, you bet, man, I want that. And so, I've been on board with these guys doing the AI stuff, and I watch lots of YouTube videos, and I stay up on all the AI stuff, and I know all the brands, I know all the things, and I know all the controversy, and and I use them all. I've subscribed to every single one of them. So I have Grok and I have all this stuff, and I'm building all these tools with it, and SFO magazine, and we're building out all that terminal stuff and all those calculators, and I use it in my trading all the time. And I'm like, yeah, that's a good idea. I could probably do an AI class at the university and teach people how to use, not just in trading, but we could teach people how to use AI and then apply it to our trading. So it would be kind of double focused. It would be like, this is what AI is. This is how you use it. This is all the neat things it'll do for you. I know you can chat with it, and people are like, oh, you can ask it questions like Google. Oh, it goes way beyond that. All right. So we could teach you that. And then when we say, well, what can we do with it? Why do I need it? Well, we'll apply it to trading. And that would be a fun class, I think. If you think that would be a fun class, give me a thumbs up, man. And I'll look over after class and I'll see how many thumbs up I got, or at least leave a message or something, so that I know that you think that's a good idea. And I'll teach a class on AI and then apply it towards trading. All right, that's our little sideline. Let's get back to what we were talking about. So that's the spread. That's just your spread percentage. That's just your last price. I don't know. We don't even really need that. I don't know. That's just the last price that somebody closed out a position on the bid and ask. And of course, it's always going to match the ask, because that's where or the bid, right? It's going to be the price that they've paid. They paid $8.65. The bid ask was $8.60. So they paid 5 cents more than what the current ask is. Do you need to know that? Not really. Take it out of there. It just confuses stuff, right? You don't need to have all this stuff. And then day range. This is your day range. Well, it's gone between 8:30 and 9:35 on your spread. So that's the price of what it's traded in the range today. Do you really care? Not really. I don't really care. Take it out. It just confuses your window. You really care what the day's range is on the option spread? No, I don't really care. Who cares? And then probability being in the money, probability being out of the money. Do you really need both columns? Not really. If you know what 24 is, the other side of 24 is 75, 25, right? 25, 75. It's just the two columns, the opposite side. And then, of course, then 24 is the probability of being in the money is the same as delta. Do you really need those? Not really. You got delta. You can come in here and turn them off. They just do the math for you. Probability of being in the money, out of the money. Look, when you do that, your options table is really simple and easy. We're not flying a 747 here. We're just little small speculators. So as a small speculator, you just need a small set of tools. So you need a little cockpit. You don't need a great big cockpit like you see in a 747. That's not us. We're not Vanguard and State Street and BlackRock. We're not flying 747s. We're flying a little two-seater, little one-seater airplane. We just need a few dials and a few things. One of the most important things, though, is that theoretical value and the premium, right? Premium, theoretical value, the spread, the open interest, volume, and the delta. That's it. That's the most important stuff to us. That's all we really care about when we're trading. So when everybody's looking at options and they're like, oh my gosh, I got to know so many things. It's like sitting in the cockpit of a 747, when in reality, all you're going to be doing is flying a putt-putt majig, right? You're going to be flying a little Sopwith Camel. All you need is All you need is the steering stick and a speedometer, because that's all we're doing, right? Now you can get all that fancy stuff and look at all that number stuff if you want to, but in reality, you can skinny it down to just some of these very few things and be happy with your options and not confuse everything and make it so complicated that you're scared to trade them. So now that, given that little introduction, all we have to do is come in here and decide whether we think the market's going up or down. That's it. Now, is the market going up or down? It's going down. Okay, well, we probably want to try and make money when the market goes down. How far down is it going to go? Well, we're going to run our Fibonacci ruler and we're going to take a look, and we're going to say, well, if we're going to come in here and look at this back from the point of where the market started to go up out of the, and that's what I like to do. I'm not here to tell you what to do. I'm just telling you what I like to do. That's the accumulation stage. So I don't count the accumulation stage as part of the run. I wait until the accumulation stage is over, and then the run starts. So it starts to run out of the accumulation stage. This is where all the big banks and hedge funds buy all their shares. Remember that? This is where they buy their shares. And it's called the accumulation stage. So all the banks and hedge funds, they buy it here. And then when the market starts to run, this is where all the retail traders buy in. We buy all the way up that thing. Well, who's selling to us? It's the big banks and hedge funds who bought them all here. They're selling all the way up the uptrend. So there's 4 states called the 4 seasons, right? You've heard me say that before. There's the accumulation stage, there's the markup stage, there's the distribution stage, and there's the markdown stage, right? So that's your 4 seasons of a trade. So accumulation, markup, distribution, markdown. So once they get up to the top, they get up to here, they want to distribute. They want to get rid of all their shares, and then they mark down, and the market comes back down. So that's what we're doing here. So we're getting a nice little ABC pattern up here. ABC, just like that. And now we're expecting to come down somewhere around 100%, which is actually 61% is the bottom half of the 1 standard deviation. So if that's 1 standard deviation, we expect the market to come down into this region right in here. That would be a nice spot. That's a good little target for it to go to. So if we say, well, we think the market's coming down, how do we make money when the market goes down? Well, you buy a put option. We're going to come down here and we're just going to go to puts. So we say put option. We're going to come to at the money, because we're just going to probably, most of the time, we're going to buy at the money. If we think we're going to make money market when the market goes up, we're going to buy at the money. If we think the market's going to go down, we're going to buy an option, a call option, put option. We buy at the money. Most of the trading just is done at the money. Not that you can't go in the money a little bit or out of the money a little bit. You certainly can, but most trading is just done right around the money, near the money. So right here we go. This is $250 put, and it's $1,582 is its premium. It's got 120 days, just like a house earnest money. So we're going to put down earnest money on a house. We got 120 days until we have to make the decision to either buy the house or not, or buy the underlying stock in this case or not. And our earnest money is $1,582. Now the theoretical value is $1,433. So we know we're paying $100 more than what we need to. So what that means is there's the possibility, as soon as that market stops going down and maybe goes up for a day, that's going to crush by about $100, $150 in this case. That's what's happening. We're paying $150 more for it than what it's worth. But it might go down for the next 5 days. We don't know, right? We don't know. But we got a pretty good target down there. We think it's going to go down, but we might have a crush because we're buying it on a day that it's going down. If you buy a put option, which makes money when the market's going down, on a day that the market's going up, you get it for a discount. Like right now, if we went into a call options, look at call options. The market's tumbling down, right? And so if you come in here and look, well, the premium is $1,797. Well, you can buy it for $1,790. Well, it's a little bit less than, it's $7 less. So you can buy a call option. So that's showing you that you got a premium on your option of about $150. This is, you can buy it for just basically what it's worth. Oh, look, even right there, 1802 is, and it's 1795. It's almost identical. So those two numbers are almost identical. So the call option is fairly priced. Call option is fairly priced. That's all that's what that's telling you. So if you come in here and you go to your put, well, the put is not fairly priced. You have to pay $15.77 for it, and it's only worth $14.27. So you have to ask yourself, if you can buy a car that is the theoretical value, or the Kelley Blue Book of the car is $1,400, and the car lot's asking $1,500. How come are they asking $1,500 for it? There better be something going on that's making it worth that much money. Well, in this case, the market's tumbling down, and so that means you make more money. Right? That's why. So if you come in here and you want to buy your call option, it's very simple in track and trade. All you do is you right click on the number you want, which is usually at the money, and you just say buy the order. Now, if you hit buy, I wish in track and trade they didn't say buy, because you're not actually buying it. All you're doing is you're adding it to the ticket. So it should say add the ticket or something. So you click that buy, and it puts it on the screen, and it puts it onto your window, onto your ticket right here. Because when you do options, oftentimes you'll do more than one at a time. So you might buy the put, but then to pay for it, you might come up here and sell a call. This is called a bull pair, a bear put spread. So you come in here and you say, well, I'm going to come in. That's a put option. Now we're going to come in and do a call option, and I'm going to sell a call option out of the money, and I'm going to sell one up here, maybe up here somewhere, $500, and I'm going to have that. I'm going to sell it. So now I'm not really selling it. I'm just adding it to the ticket, right? So I sold this one for $500. I'm buying this one here for $1,500. So really, I only have to pay $1,000, right? So I'm just going to sell a call, I'm going to buy a put. So you can do that, and that helps you pay for it. So you're going to receive $550 for selling that call, and you're going to buy a put down here. So you're going to pay $1,500. So it really lowers your value by $1,000. But let's not get fancy like that. Let's go ahead and delete that. Let's remove that one from our table. But the whole idea is that when you're down here and you click on it and you say buy, it's not really buying. Just keep that in mind. It's what it's doing is you're saying that you're going to buy, and it's adding it to the screen so you can see it in relationship to the chart. So you're building your little options model on top of the chart so you can see it in relationship to where the markets are at. And then it puts it over here in this table. So it puts it in the order ticket. So this is your order ticket over here on the right-hand side. And this is where you bid for it. This is your bid, and this is your ask, just like we saw down here. This is your bid. This is your ask, right? $545 on the bid, $555 on the ask. It's $10 wide. Well, right here, it tells you what the bid is, and it tells you what the ask is, and the midpoint is halfway between. So you always want to start at the midpoint, see if you can't get a better price. If you can't, you might have to go up to where they're asking or down to where they're bidding, depending on whether you're buying or selling. But let's get rid of this one. This second line right in here is that second option we put in. You can see that's our call option that we sold. So we're going to go ahead and we're going to clear that one, take that one off, and it comes off the table. So now we still got this one on here. This is just the put option, and that just says, hey, if the market goes down, we want to make money. Now, what's the decay on that? Remember, we have the decay, because it's going to decay, and we're going to see our premium per day about $14.98 per day. So if it's going to decay $14.98 today, the market's got to fall far enough to make up $14.98 per day on average. So let's come in here and see if the market. Now that's also all the way out here to this purple line. Remember, it's basically a carnival game. So this is a carnival game. Let's get rid of all the drawings. And we're just going to remember right here, this is our target point. So we'll put that right there. This is our target point. It was like right here. And then we're going to come in here and we're going to use our little dollar calculator. You can just come in here and say $1,580 right there. And you can say, if the market goes all the way from here to $1,580, that's my break-even point. That's how easy it is. Just $1,580. That's about as close we're going to get. And look, it's right where our target is. So that right there is your break-even point. But that's only if it has to wait clear out here. Remember, delta goes really slow at the beginning and fast at the end. So if the market comes down, and let's say it just keeps coming right straight down, and it hits the red line right here, oh, you're going to make a lot of money. It's only going to be break even way if it doesn't hit there till that purple line way out there. So that's the carnival game. Is that little snaky thing, that red, green, and yellow snaky thing, going to fall down to that red line faster, or is it going to take a long time to get down there? Or is it not going to go down there at all? Is it going to turn around and go back up? What is the little snaky thing going to do? That's how you know whether it's going to make money. That's determines whether you're going to make money or not. Whatever that little snaky thing does is going to determine whether that option makes money. The faster, because it's a put option, the faster it falls, the faster you make money. If it goes out here, it's the slower you make money. You're like, wow, how do I know? I'm going to show you a neat little tool that I love. All right, let's come over and let's learn about a new tool. We're going to come over. I'm going to pull up the. All right. This is our options book. You guys all got this. If you don't have it, go over to the Pit News Pit News, or go over to SFO. I'm going to have a real hard time with that. For 25, 35 years, I've been calling it Pit News Magazine. Claire changed the name to SFO Magazine. That Claire. All right. So sfomagazine.com, and get this little, it's in the bookstore. And if you come down here to the very bottom, you're going to see it's got all the stuff we talk about in class, but it's got all the different strategies. So there's a strangle, there's a straddle, there's a strangle that we write, there's a straddle that we write, there's a credit spread, there's a debit spread, there's an iron butterfly, there's the iron dragonfly. That's kind of my little thing. I made that up. And then iron condor, you got your iron condor in here, reverse iron condor. You got all your little strategies are in here, and it shows you how to set them up using track and trade, where you drop the files, right? Strike, at the money for a straddle. So it tells you how to do all that stuff, and kind of tells you the logic, and it tells you all that neat stuff. This is over in the Pit News Magazine bookstore. All right, go get it. It's free. It's part of your class. All right, so let's come in here. What was I going to do? Oh, I was going to show you this really cool tool. It's called Options, and I got no affiliation with these guys. I just like it. Options Profit Calculator. Can you see that up there in the URL? Options Profit Calculator. This is pretty simple. It's kind of an ugly little website, but it works really good. I like it. So now we're going to come in here, and we're just going to do, and usually I just use these custom ones, but you can come in and do the advanced ones if you want, because you know that an iron condor's got 4 legs. So you just use 4 legs and go fill in the information. Or if you don't know that an iron condor's got 4 legs, you just come over here and say iron condor, and it'll put in the 4 legs. Okay. But we're going to just use 1 leg. So this is 2 legs. So we're just going to do a long put. That's what we're doing right here, long put, because Apple's going down. So we want to make money on the way down. So you go long put. So you click on that, and it's going to bring you into this little window here. Now, the way they make money is with all these ads. So they pop ads up all over the place. So just be aware of that. So this is a long put. That means you're bearish, meaning you're going to make money when the market goes down. What's the symbol? Well, we're going to put the symbol in there, and it's AAPL. So we get the price on that, and it puts your current price in there at 249.35. Now, this is probably 20 minutes delayed, so just take that into consideration. So we come in here, our option, we're going to buy, right? We're buying a put, so we're going to option, select the option, and it brings up this window. Now, remember last night I told you half these guys in the world turn their options tables upside down? Well, this is one of them. This guy's got his options tables upside down. So the smaller numbers are at the top, and the bigger numbers are at the bottom. So you have to come in here and get rid of this ad if you can. It's not going to let me. Leave the ad. All right. So we're going to come in here, and we're going to say, I need to select the price of the option that we want. Well, we're going to go back over to track and trade, and we're going to, which one do we want? Let's get rid of all of our drawing tools. The one we want is the 250. Oh, we were doing calls. Now I've got to do the put. It tells you right there. That's the one we want, the 250 put. We're going to buy one 250 foot with 120 days, and 120 days is July 17th. So we take that information, and we're going to go back over to Options Profit Calculator. And you don't, I mean, Options Profit Calculator is cool, but you don't need to use it on every single one. It's just cool. All right. It just shows you your profit on them. So if you're looking at a pretty complicated, you can come over and look and see a pretty complicated setup, then you can come over and look. So you come in here and you go buy option. I'm going to select the option, and we're going to come over here, and we're going to go out to July, find up here July 17th, right there. Isn't that what we said? July 17th. Yeah. July 17th. Okay. Come on. July 17th. So you click on July 17th up here in the top window. And you got July 17th because that's the expiration of your option. So now we want the at the money, which was 250. So we're going to do the 250 call. See, it's right there. We dropped it at the money. If you're going to do it a little bit in the money, you can push that up there. See, a little bit in the money. Now it's a 255. That means your delta went from 45 to 50. We might want to have a delta of 50, because remember, we're going to make 50 cents or 50, the same as whatever the number of shares are that we own. 50 shares as opposed to 44 shares. You can put up a little higher. Oh, I want 60 shares. Yeah, but you're going to have to pay a higher premium. The premium goes up to $2,350 versus $1,580. We'll just do it at the money. It's only 44. We could push it in one. Let's do this one. 1,800. Well, it goes from 15s to 18. That's a lot of money. And look at the theoretical value is only 16. Oh, let's go back down here. This is tough to buy today. Might want to wait for a little while. Wait till afternoon. It'll go down a little bit. That high premium off the theoretical value probably drop. But because the market will fall this morning and then it'll rally back up in the afternoon. That's usually what happens. Not always, but sometimes, usually. So we're at a delta 44. So we're only going to be making 44 cents for every dollar that the underlying stock moves. But that's okay. We don't have any underlying stock. So we're not trying to protect ourselves. We're just trying to make some money. So we're going to make money as if we had 44 shares. Okay. But we only have to pay $1,500. What would it be if we bought 44 shares? We come over here and do 44 shares and run that thing up to 44. 44 shares would be $10,000, almost $11,000. See that? If you're going to buy 44 shares and you're going to short the market, what you can do, it says easy to borrow right there up in the upper right-hand corner, easy to borrow. So in the stock market, you have to borrow shares if you're going to go short. You don't have to do that in the futures market. They just give them to you because you're going to offset sometime in the future. That's why they call them futures markets. So this here, you have to easy to borrow, means you're going to have to pay interest on your shares that you short. That's why we do options instead, because now you're gonna make the same amount of money as if you have 44 shares or $10,000 worth of stock, 44 shares, but you only have to pay $1,500 for it. But you only have them for 120 days too. You don't have them for endlessly. Okay. So now we're going to come in here. We're going to come back over here. So we're going to do the 250 put. We're going to come back over to our options profit calculator, July 17th, 250. So we can come down here. 250 is right there. And we're going to do the puts. So we're just going to do the midpoint, all right, because we're going to assume that we're going to get the midpoint. So we just click on that. And that comes in here, and it puts that price right in there to that option. Now we just hit the calculate number. And what it does, it gives us this little chart down here, this little table. See how cool that is? That tells you whether you're going to make money or not and where you're going to make money. So it's a put option, so it makes money when the market falls. So anytime it's inside of that green line right there, see that in that green, that's where you make money. This is your expiration, which is out here. So if we took this, I mean, we could take this, right? We could come in here and we'll do this little snapperoonie just for fun. We can take this. I just grab that and it becomes a little picture for us. And now we go back over to our track and trade software. That tells you where you're going to make money on the call option. Remember last night I said that an options table, the value of an option looks like a amortization schedule of a house. You ever seen an amortization schedule on a house? You know how it does the options and how, you know, where you kind of got that crossover point where you get to the point where you're making more, you're putting more money in your house and you're paying interest. That's kind of what an amortization schedule looks like, and that's what an option. When you're making money on an option, this is where you're making money. So you can see down the scale, all the way down. So they didn't turn it upside down here. So it's upside down over there, but not on here. So now you can see this is where the market's falling, and you're going to be making money. Now, if you wait too long, see, because you got to cover the cost of the premium, you can see out here, this, you lose 94% of your money there. You lose 100% of your money. See that? And then as you get down here, you're losing 51% of your money, 42% of your money, 32% of you're making money. You're just not making enough to cover the cost of the option. Remember, the option's premium. You have to pay for that with your profit. And so if you don't make enough money to pay for the premium, so if the market falls really fast, well, you can take some profits here, because if it falls really fast and then suddenly just goes sideways, well, you eventually lose your money. Why? Time decay. So you can take your profits fast. If it drops down in here, take your money. $31, $31, $32, $33 per 31% return, $500. See that? See how cool that is? So then you come over here and you look at that on your chart and you realize, hey, what Land is telling me is that if I take this little picture, this is basically, if I could get this, I hate Windows sometimes. Come on, give me what I want. Okay, so that's basically what we got going here, right? So if this thing was, if I could draw that just a little closer, it's not gonna let me. So that's what we're looking at. Right there, that's our strike price. See that little line right across the center right there? So if the market falls down into this region here, it's all going to be green. If it goes anywhere up in that region there, it's all red. That's all red. So that's why I oftentimes tell you, when a market moves, when you're buying a call or you're buying a put, it has to almost be explosive, because it has to explode down into this region here. Because if it doesn't, if it just wanders out into this region, anywhere in this region here, you're going to lose money. Now, you might not lose 100%. 100%'s up here, but it's got a scale. It goes down a scale of how much you're going to make but it's not really making, it's losing. You're just not going to lose all of it. Okay. On expiration, you're going to only lose 27% of your premium, or you're going to, 70% of your premium, you're going to make 27% or something like that, right? Along that scale. See that scale. So that's how it works. Let's go do a call option, just because sometimes people are like, I don't know how you make money when markets go down. So let's exit that chart. Let's see, Apple's going to go up. So if we come in here and we buy a call option right now, we just come in and we go over to our options table and we say buy a call, and it's a 120-day call. Buy a call. We're going to just buy it right at the money. And again, if we're going to buy, let's go to the calls so we can see it. There it is. It's going to make money as if it were, make or lose money as if it had 56 shares. That's what that's telling you, delta, 56 shares. And if we did the probability of being in or out of the money, it'd be 56, right? 56, but let's go turn those on. Let's turn those columns back on for you. The probabilities. So probability in the money, out of the money. Let's go turn those back on. So now we've got probability in the money, probability of being out of the money. Delta is 56. So the probability of being in the money is 55. Probability of being out of the money is 44. It's just basically 50-50. So anytime you buy an option at the money, you got basically a 50-50 chance, unless you're doing your mathematical modeling and you're saying, well, I think I've got, I'm a technical analyst and I'm pretty good at guessing the market's going to have a little bit more downside potential. We've also got a nice little stopping zone right here. This is going to be a hard area for it to go past. See, it's got a line there. This area support here, area support here. That's kind of a good little target for it right there. If it breaks past that, it'll probably go down to 130.9. or at least down past it, down to 100. So that's kind of where we're looking at it. We still think there's some downside potential, but maybe not. Remember yesterday when we were trading, we were day trading. We got to a point where it's going to test this previous low in the market. We were trading the S&P 500. And we said, well, let's buy a call right here just in case it turns, bounces off of this little level right here and starts to go up. And it didn't, did it? It went right down through it and kept going. So then we had to mitigate with a bunch of put options. And we tried to make money or selling calls to collect premium. We're doing all kinds of things to try and mitigate that downside loss. That was yesterday. Go watch that video. Watch me lose a bunch of money. But that's what we were thinking. So if we take that same thought, well, maybe it'll bounce off that red line and start to go back up. Okay, we're trying to justify why we're putting a call in when the market's going down. Calls make money when markets go up. So let's come in and go over to our options profit calculator, and we're going to model this thing out. So we're going to come in, and again, we're going to do Apple current price. Let's just get it again. Current price, we're going to buy and we're going to select, and we're going to go out. We're going to do the same time frame, 17th of July. This time we're going to do a call, and a call is on this side. We're going to go to do a 250. Isn't that what we did last time? We did 250. So this time we're doing a 250. Yeah, we're doing a 250 call. So we're going to go 250, and we're going to do the midpoint. And we just come in here and hit calculate. And now look at that. There's our little model. Okay, so that's our strike price, 250 right there. And you can see the market has to almost be explosive to make money, because all of this in here is still loss all the way up there above the strike price. That's all loss. And that's that line I draw for you, right? So anytime you come in here and I go in there and you go, okay, how much money, where's that line at on the screen, Lan? Well, all you do is you come in here and you say, how much is my premium? My premium is $1,792. So you draw a line, $1,792, just like that. $1,792. You find it on the expiration line. $1,792. It's about right there, and that's your line. See, anything above that is green. Anything below that is red. That's that table right there. That line. I just drew that white line right there. See that white line on this? That's the white line I just drew right here with the dollar calculator. That's that line. So if you buy a call, anything below that line is going to be red. By how much? Well, it's not easy to tell you. So how much are you going to lose? Well, it depends. Depends. The market comes here, you're going to lose 35. 35% of your trade. You're going to lose $625 of your premium, of your $1,792. So you're still going to make some money, but you're going to lose $672. If you come down here, you're going to lose 100%. You're going to lose all $1,800. That's saying 1,800. It's 17,892. Yeah, 1,800. Pretty close. So it's not a single number. It's a graduated scale. But that's your line. That's all you have to do. You just say, oh, well, 1786 to the expiration date. That's it. Very simple, easy. You just do it right on the chart. Now you know when the chart moves. If you have one of those little tables off to the side of the screen, it doesn't tell you anything. It doesn't show you where the chart's moving, whether you're in the money, out of the money, whether it's, this pattern, that pattern, areas of support, resistance. It doesn't show you anything. It just shows you, oh, this is it's cool. I like it. But if you don't have the chart, what good is this? Right? You got to have the chart. So that's the chart. So now we know we're going to put our option there. Now, what if you do this? What if you came in here and you said, well, I bought it far out of the money chart? Well, all you did is you just extended. Okay, so we reduced it $855. Let's buy this far out of the money one. Let's do one that we can see the numbers on. I like that $855. So let's say $855. So now what we do is we take our dollar calculator and we go $855. Let's take this. We put it right on the little triangle. We take this one here, go $855. $855. Okay, so that's our new, everything below that line is all red. And the market's already way down here. You want to talk about explosive? That thing's going to have to go way the heck up here fast. Let's go put it in. Let's go look at where that thing ends up. All right. So it's less money, $847, but the market still has to come to this point just to break, just to get you, just to break even. And it's already way down here. So you're starting it, behind the, it's just the probabilities of that thing being in the money. You come down here and look, it's got a 62% probability of being in the money. Whereas this one, or let's see, go the other way. That's a call option. We're on the call options. It's got a 37% chance of being in the money. Whereas before you had a 55% chance, but you paid more for it. 37% chance of being in the money. But that's how you do it. You say, well, it's got to go there. Well, let's go put that in there. It's a 270 call. Let's go put the 270 call in. So we'll go back to our little window. We'll select it, 270, same date, 270 call. Go down the scale, not up it. Go over here to the call side. We're just going to go to the midpoint, 860. Put that in there. Come down, hit calculate, and there you go. So now your 250 is where your line starts. So you don't make any money until that thing right there at 250, but the market's still trading way down here. So 250 is right there. You don't make any money until the market gets above there. And if it goes clear out there, anywhere out here, this is all red zone. All lose on your call that you bought way up there. So that market would have to go really fast up into here and stay up into this region to make any money. You got a very low chance of that happening, right? That's why you sell it, collect the premium. You buy it up there, well, you're going to have to pay $850, and then your chance of making money is only 37%. You got a 62% chance of losing your money. That's not a good bet. You can go down to Vegas and get better odds than that. So that's why you sell it. You got the odds at 62% chance. You got a 37% chance of making money. You could even push it out a little farther. You could come out here and say, well, I want to have an 80% chance of making money. Okay, we'll go all the way out here. So there's your 79.95, 80% chance of being out of the money. It's way out there. Well, how much money do you get if you sell that one? Well, you get $335. What do you think the chance is of the market's going to be above that green line for you not to get your money? It's going to have to be up there. It's going to have to hit the purple line above the green line for you not to get your $335. What do you think is the chance of that? Could happen, right? What's the chances? Well, 20% chance. Mathematically calculated based on the delta Kona probability, you got a 20% chance that the market's going to go up there. And you're like, well, I'm looking at the technical analysis too, and I don't think the market's going to go up there. I think the market's on the way down. So I've even got a better opportunity than just the mathematical calculation. I'm going to use Land's method. I'm going to use technical analysis to determine my odds, not just the little mathematical model that's over in the corner. And this says, oh, I think it's going down. I think we got some additional downside potential. If it does come down to maybe 100% come down, well, it's probably going to go, even if it starts to go back up, it's not going to go straight up. It'll probably do something like this. So what's the chances of it getting all the way back above that green line? Well, probably not very good. And it's $335. So what we oftentimes do is we'll put that on there. Let's go ahead and put that on there. Oh, that's buying. We got to sell it. So we got to switch this over to, we got to sell to open. Sell to open. So we're going to place that on there, and we're going to actually sell one. We collected the premium. The problem with that is they're going to make us pay a big commission or a big margin. We're going to have a lot of money in our account to sell it naked. That's a naked call. They don't let you do that very often. I mean, they'll let you if you have a lot of money in your account, but we don't want to have to do that. So we'll protect it. We'll buy some insurance for ourselves. We'll just go up here and we'll buy a call up here. Okay, so we'll sell one and we'll buy one. So we sell one, we buy one, and then you pay for that one. It's $150. That's your insurance policy, and then $335. But you have to pay for your $158 out of your $335. So that's going to reduce the amount of money you're going to make. But you could do that. That's called a vertical vertical credit spread, because you're receiving $335 and you're paying $162. So it's actually going to make money. The difference between $335 and $162. So about $150. So you can make $150, and that's for the next 120 days. But you can put those on the same ticket. Let's go ahead and let's clear those out. So we're going to exit chart, get rid of those. Yes. Take them off. So let's go ahead and get rid of all of our drawing tools. And let's do that one more time. We're going to do it with both of them. We're going to come in here and we're going to sell a call way up here so we can collect the premium, $335. And we're going to buy a call up here to protect ourselves in case the market does go up there. We don't lose a whole bunch of money, and it's going to significantly reduce our, let's get rid of it first. Let's clear it one more time. See, there's your little calculator. You're going to receive $335 right here. See what it says right there, $335. I know it's kind of small, but you can see it. And then the return on your risk is 8.22. So you're going to make 8% return in 120 days. Well, that's good return. 8% in 120 days, but we got to buy some insurance. So it's going to reduce that. But your margin amount is $4,000. They're going to margin you at $4,000. So let's come in here and buy a call. So we'll buy a little call up here. We'll put that up there. And that little call up there is going to cost us $158. That's an insurance policy that says you're not going to lose any more money than what's between those two numbers if the market actually does go up there. The max you can lose is the money between those two lines. All right. That's your max loss, $1,500. So you're gonna risk $1,500 for a profit potential of $150. That's really what you're doing. But the odds of that happening are you got an 80% chance that you're going to make your money, right? 80% chance. So now that dropped your margin from 4,000 down to 1,500. But you're going to have a return on your risk of 11%. That's 11% in 120 days. How many figure that out for an annualized return? What is that? And your chances of getting this 80%. That's better than you can get at Vegas. You can't get 80% chance of making money in Vegas, especially when the market's going down, right? So how many? Let's say we got 365 days divided by 120. There's 3 of those. There's 3 of those in a year. So if you did that 3 times, and each time you did it, you made 11.8 times 3. That would be an annualized return of 35%. 35% annualized return on your money. Just doing that little strategy right there. Okay, so that's why people do that one. It's way out of the money. It's way up here. They're going to give you this little $340. You're like, man, that's not very much money. Yeah, it is. It's 35% annualized return. That's a lot of money. All right, and you got a real high probability of having that pay off. So that's how that works. So let's go ahead and hit cancel on there. But that's your little options profit calculator, and it's a really neat little tool. And it tells you, where the green zones are, where the red zones are. And once you figure that out, you can just kind of do it on your own over here. You don't have to come over here to the little options profit calculator. You just, where your line is. I'm going to buy it here. You know where the expiration line is. So we're buying a call, and then you just take the cost. Its cost is $1,802, and you just draw your dollar calculator up to the purple line, 1,802. 1,802. There it is. It's about as close as you're going to get. That's your purple line. That's your white line that you got over here. Same thing. It's that white line right there. We just drew it. So anything above that white line is the green stuff. This just tells you how much you're going to make on any given day at any given price. So it's kind of when a little table comes together. Very cool stuff. All right, that's it, guys. That's all I got for you today. I'm going to let you go. And I think that was a good lesson. We covered very nicely what was going on down here in the bottom window, all my opinions, and then showed you how to do some of the probability stuff. We talked about delta, and I showed you the options profit calculator, which I think can be really helpful and handy for you. Okay, and I'm seeing Robert saying he would love to see the AI application would be cool. I've got AI applications. Robert Drabicki. I got Robert. Let me show you. Let me show you. I give you a sneak peek. All right. All right. I'm going to give you a sneak peek. This is what we're working on. It's not available yet. It's for people who own SFO magazine. All right. So if you have a subscription to SFO magazine, this is what you get. Not yet, though. It's not quite available. Let me see if I can get it to come up here. Hold on. I'm going to show you. It's stuff we're working on with AI. So I'm going to come in here and we're going to go into come on, let me in. Okay, so these are all the calculators that we got. Let me show you a really cool one. The first one I'm going to show you is the that we're working on. This is called the hedging calculator. I think that's nope, not that one. Options. Nope, not that one. Yeah, is it this one? No, not that one. It's there's got so many of them in here now. I can't remember which one's which. Is it this one? No, it's not that one. These are all the things that are coming to you. We're going to have this for the subscribers to SFO magazine. Let me see. The magazines, life. This is really cool. We played with that one the other day at life expectancy. Tells you when you're going to die. And then if you know when you're going to die, then you can plan for your retirement better. Is it the hedging calculator? No, we did that one. Hedging optimizer. Nope, it's not that one. Steamroller. Oh, it's this one. Steamroller. All right. So we were coming in here and we're saying, what's our account size? Let's put in here $50,000 and we're going to trade Apple and we think it's going to drift lower. Okay. So we come in here and we turn it on and it goes out and it tells us whether we should be putting on that spread that I just showed you. Now it's saying it's halted because it couldn't determine whether we've got an earnings coming up. Well, we don't. So we're going to override that. Now it's coming up and say, well, you don't probably really want to do that because it's in the chop zone. It's between the implied volatility is only 28, and we want it to be between 25 and 50. Or if it's between 25 and 50, it's in the chop zone. So you can say, well, you know what? I'm going to push it out a little further. I'm going to do it anyway. So you can say, I want to do it. So then it'll come in and it'll tell you, oh, now it's stopping you again. Liquidity is saying that the open interest is low. It's only at 284. You got to take that into consideration. Let's override that one too. All right. So if we override those three things, come on. Don't fail on me now when I'm trying to show off. All right, here it comes. All right, there's our strategy. I know the words are small, the letters are small. Maybe I can figure out how to make those bigger. But you can see that it's a bull call spread. Oh, this is a bull call spread that it's telling us to do. Oh, a bear call spread. Yeah, okay. So the ticker is Apple. Expiration, we're going to do 43 days out. And we're going to sell a call, the 265 call, and we're going to buy the 270. And we're going to spread is going to be $5. And the contracts, we're going to do 2 of them. And the net credit is going to be $1.09 per, which is $218. And so your max risk is 782. So you're going to risk 782 for 218. But your probability of being in the money is going to be very high. We got to get that in here. But it's still not done. I'm still working on it. There's still more numbers I want. Max profit is going to be 218. Risk on the account is 1.56%. So your risk is, if you got a $50,000 account, it's going to be risk basically 2% of your account. And the IVR, the implied volatility ranking, is 28. So I'm not done. I still want to put some more of that stuff that we talked about in there, but this is kind of what it's doing. It's going to go through and it's going to help you determine whether those little, it's called the steamroller, because you don't want to step in front of a steamroller to pick up pennies. So you want to make sure that you're doing your math right, and that's what this does. It helps you with that strategy, because that little strategy I just showed you is a very profitable strategy, and it's really popular. It's really common. Lots of people love doing it, and so because it's so popular, I got a little calculator that helps us do it. So if you think that the market's going to drift higher, you come in here and say, okay, I think it's going to drift higher. And then it'll come in and take a look at it. Oh, it's still going to be, well, this is still, it can't figure out whether the earnings. So you have to say, nope, there's no earnings coming up. And then the IV rank is between 25 and 50. So it's sitting at 28. So it's still in the chop zone. So you're stepping in front of a steamroller to pick up pennies. It wants you to make more money than that. That's what it's saying. And then again, it's coming in here and it's saying that we don't have a lot of liquidity on this particular contract. So we're going to go in there and override that. And there's our trading strategy. So we're going to come in. I'm going to fix this. I'm going to put more of that stuff in there that we just talked about. So you wanted to see some of the things that we're doing just for fun. This is something that we're working on. So you can see we got a little news thing that comes in here. It's a news scanner. Goes out and scans for all the news. Tells you what's hot. Nvidia's in the news right now. Bank of America's in the news right now. PT, Stifel Life's, whatever that is. Tesla. There's a couple articles on Tesla right now. So it tells you. It looks at all of these news agencies, finds out what they're all writing about, and tells you how many articles are about a particular subject. So NVIDIA is in the news today. So that's the one that is going to be moving and shaking. It's a hot one. Then we got this. This is really cool. This is your crypto markets and stuff. You can come in here and see all that. This is a chart book. Then we got your life experience. Tells you when you're going to die. We got all the magazines from Pitt News Magazine, SFO Magazine. We got the UBI course, Universal Basic Income course. So this is where our education is going to be. It's not done. This is your SPY monitor. This lets you come in and look at the S&P 500 and the different sectors. It's really cool. And then this got a whole strategy that you trade with this one. And then we got the dividends in here. This is one that you guys have seen. It's just being put in here. It kind of looks a little funny in here because it's, so this is our break-even calculator. Let's put $10,000 in here. Say I've got $10,000. And then it's going to give you your little table in here that shows you which markets have the high returns. So you can see Carvana right now. CVNY is returning a yield of 125%. MSTR Winter is returning a yield of 87%. So that's a cool little calculator that's coming. SPY dividend options, this in here. This is the options profit calculator. This is one where you come in and you say, well, I want to buy MSFO, or I want to buy Tesla, TSLY. So you put that on there, load it, and it's going to tell you which option to buy. So now you're like, well, to protect it to the downside so you don't have your NAV decay, come in here and buy this option. You'll make 7.36% return. This will make a 10.95% return, or this will make a 14.27% return. So you can click the one you want. Let's say I want this one at 10.5% return. You come down here and it gives you all your numbers. So it tells you how many shares you need to buy and how much total capital you need to make that type of a return based on Tesla and having a put option to protect your downside. And it does the math for you. So that's one tool that we're working on. Steamroller, hedging optimizer. That's that one. Oh, this is if you're going to be doing Tesla and crash. So, right, Tesla is the long side, crash is the short side. And so you click on that. You say, well, I want to buy some Tesla. And you say, well, how much do you want long one side? Or how much do you want short the other side? Or I want it right in the middle, 50-50. And it comes down and it tells you your returns and where you're going to make your money, and 50-50 short, 50-50 long, and how it all works out, all the balancing on that. So that's a cool little tool. Hedging optimizer, that's that one. And then we got delta probability. So this is really cool. Come in here, go TSLA, look at Tesla, and you come in here and you can move your, it's gonna do your delta Kona probability for you. So if you put that down here, you say, well, this is the accumulation stage. You're going to come where it broke out of the accumulation stage right there. Well, right now it's got a 71.6% chance of being bullish. So it's still got some downside potential, but it's coming back. If you come back a little farther, we come all the way back to the beginning, back to here. You can say it's got a 38% chance of going bullish. Still got some downside potential on Tesla based on the entire move from top to bottom. So that's what that's telling you. It's kind of cool. And then, so that's your delta Kona probability. Portfolio matrix. Of course, portfolio matrix is where you do all of your managing of your portfolio. Once you have all your money, then you've got to manage it. And you're getting dividends coming in. It tells you to reinvest your dividends and where to put all your dividends and maximize your profit potential. It's a whole system in itself. It's really, really super cool, super duper cool. And then, of course, you got track and trade, which is the software that we're using today. So those are the tools that we got coming out for you in SFO Magazine for those of you who wanted to see. And these, believe it or not, were all created by me using AI, artificial intelligence. So when I say I'm not an expert at it, I'm not. I'm not an expert at coding and all that kind of stuff. But I was able to do all this stuff with AI. And so I think because I know how to do all this stuff, but I used AI to do it. It's not because I know AI. I know AI. It's because I know how to trade. And I was able to tell AI to create these things for me that I wanted because I knew what I needed. And so I was able to guide AI to do it. So you need to have some knowledge on what you want so you can tell AI to do it. But you need to also know how to tell AI to do it. And so I think I can teach a class at the university. I think that would be fun. And I'll show you how we can take AI and build things that we already know that we want. So we have ideas, something we want, we'll just have AI build it for us. That's what these all are. These are all tools that I had AI build for me because they're things that I know can help me in my trading. And if I'm going to help me in my trading, well, I'm a teacher, so I like to help guys in my class have these tools too. And so that's what SFO magazine is going to be. I call this the SFO terminal. All right. Not a Bloomberg terminal. It's an SFO terminal. All right, guys, I've played around long enough. We're going to let you guys go for the day, and we will see you. What's today? Today is Thursday. We'll see you tomorrow night. No more classes online. This is the last class until next Tuesday online. Tuesday morning at 9 o'clock, we'll see you here bright and early. For those of you who are not with me at the university, for those of you who are with me at the university, we'll see you down at the university tomorrow night for our final class of the semester, Friday night. Friday night, final class of the entire semester. So we'll see you then. Take care. Oh, yeah, can't get this yet. It's not available. But you can subscribe to SFO magazine. Then you'll be grandfathered in. All right, see you guys.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.